Hello everyone, welcome back. This is still Accounting 312, chapter 21. Finally, we finished the first part. We are going to the second part. We talk about cost analysis. So I don't want to see too much detail here. I want to just give you some idea about what we will cover in this part, okay? So general idea is why we call it cost analysis, relevant cash flow. So what we are trying to do it here. Remember when we did our NPV analysis, IRR or AAR, payback, whatever, you are already given with all the cash flows, right? You know, hey, the net initial investment is 48,900. And you know every year is this. So you calculate NPV, IRR, or the return or whatever. But how did you get all these cash flows? Let's say, hey, why is 41,100 as the cash flow from selling your old truck? Why is now 42,100? How do you get the number? That is what we are trying to do in this part. So in this part, you will have the raw data, okay? You will have the raw data. Your job is convert all this raw data to the final data so that you can use it to calculate the NPV, IRR, AAR, or payback method. So although this is the second part, actually it's flipped over, right? So actually this should be the first part. From this part, you get all the clean cash flow numbers. And then you use the clean cash flow numbers to calculate all the measures. So that will be your final exam problem. Two parts. First, calculate the relevant cash flow after tax effect. Second, use the clean after tax cash flow to calculate NPV, RRR, ARR, all those RRs. Okay, so I hope you understand what we are trying to do. So let's read this case together. I'm not going to read, word by word, but tax rate 40%. And I told you the operation, you will get this before taxes, this for the first 4 years, 220, 5th year, 170, and then you use straight line depreciation method. Then the rate is 8%. And then you also have old bus, new bus. So let's look at all the numbers briefly. Remember, we focus on the relevant cash flow. So purchase price 660,000. So that will be your purchase price, right? And then your old one, book value, selling price, right? So your depreciation expense, the taxable calculated for you. Your old one is 12,000, your new one is 132,000. So your relevant cash flow will be 120,000. Your relevant depreciation expense, your extra depreciation expense will be 120,000. And your old working capital 6,000, your new working capital 36,000. So your relevant working capital will be 30,000. You say, hey, Professor, those numbers look familiar. Yes. That 30,000 is this 30,000. This is the relevant cash flow. The more depreciation expense, 120,000 is here is 120,000. That's the relevant cash flow, right? So we take care of the relevant part. Okay, now let's look at what we are trying to do. We said we want to get all the cash flow so we can do the NPV or we can do whatever we need to do. Remember when you learned financial accounting, I believe when you did journal entry, you kind of break the whole thing to 3 parts, right? When you first bought the equipment, T equals to 0. When you use it, 3, 4, 5, right? So when you bought it, you debit equipment, credit, cash, kind of like that. And then when you use it, you debit accumulated depreciation. You debit depreciation expense, you credit the accumulated depreciation, and then when you get rid of that one, you take it off from your book, right? So similarly, when we do our cost analysis, we also have 3 parts. When T equals to 0, and then when you use it, and then also at the end of the project when you dispose it. So we have 3 parts, and then we want to look at how do we get the after-tax cash flow from each part. The first one, we call it the net initial investment, is when we first bought the equipment. 3 parts, you already kind of got the general idea, right? We said you already kind of got the 3 parts, right? The first 2 parts, straightforward, you know, purchase price 660,000, extra working capital 30,000, and this one is when you sell your old box, what's the cash inflow after tax. Remember, if you did this practice, you should know when we do after tax cash flow, we do other adjustment based on selling price. So we always start with the selling price. Your old one selling price is 28,500. Your book value is 60,000. Your disposal value is 28,500. You tell me you have a gain or loss. You have a loss, right? So you have a loss. How much? Loss is 31,500. When you have a loss, you pay less tax. Am I right or wrong? Yes. How much less tax you pay? You pay 40% less tax of this loss. Because of the loss, your operating income will decrease by 31,500. So you pay 40% less tax based on it. So that's the reason you add tax saving from loss. When you have a gain, you have to subtract because you pay more tax. So from that, we can say it's 28,500. We add tax saving 12,600. We got 41,100 as after tax cash flow from selling your old equipment. Does this number look familiar? Does this number look familiar? I want to hear yeah, yes, right? That's why we got 41,100. So at the beginning of the project, you invested 660,000 outflow. You have relevant 30,000 extra as cash working capital outflow. You have cash inflow 41,100. So at the beginning of the project, we call it a net initial investment. We invested 648,900. Oh yeah, right. So next part, when we use our equipment every year in the next 5 years, we call it a cash flow from operation. We call it a cash flow from operation. And there are 2 parts. First one, we call it annual after-tax cash flow from operation. After-tax cash flow from operation. So let's work on this one first. For year 1 to 4, before tax, your operating income is increased by 220,000. For the 5th year, increased by 170,000. But we only keep the after tax, right? 40% goes to Uncle Sam, 60% are left for you. So we only have after tax. We only have after tax. We keep 60%, Uncle Sam takes that 40%. So that will be only 132,000. That only will be 102,000 after tax. This is after tax. And the second part is tax saving from the depreciation expense. Remember, because of the new box, every year our depreciation expense is increased by 102,000. Every year is increased by 102,000. So from that, because we have a more depreciation expense will decrease our income, right? Expense will decrease our income. So when we have less income, we pay less tax. So we have extra tax saving. It's the same logic as when you have a loss. When you have a loss, you have a tax saving. When you have more expense, you have a tax saving. you have extra 122,000 of the expense, and you save 40%. So every year you save 48,000 from paying less tax. So year 1 to year 4, you have 132, 132, 132, 132 from your operation. Year 5, you have operation of 102,000. And you also have a tax saving from depreciation expense, 48,000. That is why you have a 180, 180, 180, 180 for the first 4 years, and then 150 for the 5th year. Does this number look familiar? I want to hear yeah, yes, right? Yes, that's we got 180, 180, and then 150 for the 5th year. Last part. At the end of the project, we have to get rid of our new boss and then also get our working capital back. We get our working capital back. Remember, at the beginning of the project, you put 30,000 extra working capital. At the end of the project, you get your working capital back. We get our 30,000 back as the cash inflow. And then sometimes you sell your new bus, but this question we are lucky we don't sell the new bus because at the end of the project, terminal disposal will be 0. So there is no gain or no loss. So we are very lucky. Therefore, in the 5th year, you have 102,000 from after-tax operation. You have 48,000 from the cash saving of depreciation expense. You have 0 from your selling of your new bus, and you have 30,000 as your working capital back. Does this number look familiar, yes or no? So the 5th year, eventually your cash flow will still be 180,000. I stop here. I know you may say, oh goodness, that's kind of hard. Yes, that's kind of hard, but we will talk detail in the following videos, so don't worry too much. We will definitely practice a lot. If you have any question, I copied the textbook actually. So this, usually I don't rely on textbook that much, but I copied textbook interpretation, textbook, the reasoning, the wording, so it explains how do you get after tax cash flow of selling your old bus, how do you get your annual after tax cash flow from operation. So if you have any question, I would say read your textbook for this part. And then I see you in the following videos. Thank you.